Welcome everyone to Inside India. I'm Sri Jegarajah. Your headlines. Vietnam becomes the second country after the UK to strike a trade deal with the US as India races to reach an agreement of its own. India's largest IPO of the year, HDB Financial Services, outperforms, surging 13% on its first day of trade. And India looks to boost its energy security with plans to build 3 new strategic oil reserves. Let's take a look at the Asian markets, and it's an interesting juncture at this stage because the markets were broadly higher, but some of them are starting to falter and turn negative. The Kospi, however, and the TAIEX are putting on gains of about 1%. Shanghai Composite is flat, and elsewhere we are seeing some weakness, most pronounced in New Zealand, and the Hang Seng giving back about 1.2% after quite a stunning run in the first 6 months of the year, including a shift into the bull market territory. Right, Vietnam is the latest country to strike a deal with the United States just 1 week before President Trump's July the 9th tariff deadline. JP Ong has the details now and joins me.
Good morning, Sri. And it probably pays to be early when you're try and hold these tariff negotiations. And remember that even before Liberation Day, Vietnam was already sending feelers to the U.S. to try and right or perhaps improve the trade balance because they could see the storm coming, given they have one of the 3 largest trade surpluses with the U.S. at over $100 billion. Well, this time around, they have achieved a deal, according to President Donald Trump, via Truth Social. Now, it doesn't mean that all the tariffs are going to be eliminated. In fact, it will come down to just 20% on Vietnamese exports to the United States. But given the fact that it was supposed to be 46% or 47%, this is a huge come down, actually, and something that Vietnam seems to be willing to actually stomach. In return, Vietnam is also opening up their markets to U.S. goods and proposing 0 tariffs, actually, on all U.S. exports to Vietnam. And they're also asking for the U.S. now to recognize them as a market economy, which means that some dumping duties could be removed if that is something that the U.S. will entertain. Now, remember also, Sri, that one important part of this trade deal is that there still will be a 40% tariff on certain goods that are considered transshipped through Vietnam from China, because the big concern from the U.S. is that Vietnam was being used as a backdoor for Chinese goods to circumvent some of these trade goods. Now, I do want to bring this back towards the Indian context as well, because it does give a few things, actually, or perhaps a few things that can be gleaned. Remember that the U.S. and President Trump have said that it is possible for India to actually get to a trade deal with the U.S. before July 9, actually. And perhaps this also shows a bit of a blueprint or perhaps a possible scenario for trade talks between the U.S. and India, that perhaps it won't come down to 0, but perhaps half of what was being proposed. But that also perhaps if you want to actually achieve a trade deal, you'll have to bring down some of these non-tariff barriers and open up your markets more to the U.S. the same way Vietnam did. Perhaps it's also symbolic that Vietnam was one of the first ones that the U.S. decided to conduct a trade deal with, and it's perhaps also sending a message to the world, actually, that perhaps the Vietnam can be used as an example for what you can expect in a post-Trump tariff era, perhaps post-July 9. But of course, the ball is now in India's court also as to whether or not they can actually achieve this. And perhaps it's something similar to what Vietnam actually achieved. Only time will tell, of course, Sri.
Could be a dress rehearsal. You have a great point about the transshipment and the backdoor issue being one of the potential wrinkles that has been overcome for India. I believe it's going to be agriculture. Let's see how that evolves. JD, excellent. Thank you very much indeed for that. Markets are also expecting a trade deal with India. We just touched on that as President Trump keeps saying that it is coming soon. But despite the hints being dropped by the US, there are reports of roadblocks in the framework. Former RBI Governor Raghuram Rajan was on Squawk Box Asia earlier this morning, and Rajan broke down the sectors where India would gain from a potential US trade deal and those that are a no-go for New Delhi.
Well, almost always. First, there are easy sort of wins. India can buy more natural gas from the United States, which has surplus of that. It will require sort of positioning Indian purchases. But there's sort of politically difficult places that India doesn't want to go. For example, agriculture, dairy products, Indian dairy farmers, it's a huge source of living, and they don't want to be swamped by cheap U.S. dairy products. So in that sense, there will be some red areas that India will not want to go to, but there are many other areas where I think agreements can be reached.
Yeah, you brought up LNG, right? And it seems to me that there's a very thick political layer on top of this as well, because were India to agree to buy more LNG from the U.S., I mean, from the point of view of Washington, one of the things that they want to do with India is to try and pivot India away from India off of overdependence on cheap Russian oil, no?
That's right. I think that might be part of the larger goal. Of course, there are other sources of oil nearer India than the United States. But certainly, as far as natural gas goes, LNG is something that India has increasingly used. And as it transitions to cleaner sources of energy, LNG may be the transition sort of energy source. So it is sort of win-win if India buys more of that, and certainly the U.S. has a surplus.
Staying in the energy space, India is planning to boost its energy security. The country is exploring plans to build 3 new strategic oil reserves. It intends to top up existing 5.3 million tonne storage by adding at least another 7 million tonnes. A feasibility study of the new sites has already begun, and India is targeting 90 days' worth of reserves since the country is heavily dependent on imports to fulfil its oil needs. Indian markets join us in about 45 minutes' time. Let's give you a sense of what's to come and give you a Nifty futures. They are indicating an opening number in the region of 25,574. So that would denote a lift in the area of about 100 plus points, given where we left off yesterday was at 25,453. Dollar rupee exchange rate at 85.63. Let's bring in our first guest of the programme. Rajiv Batra joins us now, Head of Asia and Co-Head of Global Emerging Markets Equity Strategy at JP Morgan. Rajiv, great to have you on Inside India. So, in your opinion, does the fundamental story of India remain intact? And if so, then, what should the playbook look like for the fiscal second quarter?
Thanks for having me back, Sri. India's story is very simple over here. We are going through trioca of a positive catalyst for India, which happens once in a lifetime kind of a situation and usually start the Goldilocks scenario for India. Weaker dollar, lower oil prices, and monetary policy, or you can say the policy making being in the easing mode, working to revive growth back. Seldomly we have seen all these 3 drivers coming together, and when it has happened in the past, it has driven a very higher growth for India. Looking at DXY heading towards a 96 direction, oil again post de-escalation of tension, heading towards a range of around JP Morgan target range of 65, 60s kind of a zone, very positive outcome, and easing still not stopping. Basically, easing is not just mean the rate cut, easing also means liquidity addition, easing also means supporting the banks and non-banking financial sector to drive much more higher credit growth in system. So taking that into account, India is on you can say cusp of revival in earnings and GDP growth overall. We will see some signs of it when from 10 July onward, first quarter earnings seasons will start. And we do believe double-digit handle will try to make a comeback over here. Some of the macro data points are also showing the same signs.
I'm really glad you mentioned the macro data. June manufacturing data knocked it out of the park, didn't it? 14-month high in June and very solid. Does that tell you, Rajiv, that India is perhaps becoming a victim of its own success? Is there anything there when you look underneath the hood at the data that is consistent with an economy that is perhaps at risk of overheating? And what are the implications then for the RBI?
No, I will definitely not read too much into the 14-month high it has made. Remember, it has come also on the back of revival in export market, and export market we know have been reviving due to the front loading of orders. And that is one particular reason why where you dissect between domestic versus exports. Exports are the one which have been the key driver of this 14-month high, what numbers have achieved overall. And this shows like the seeds which have been sown by India 4 to 5 years back post-COVID, that that economy should not be just driven by domestic demand only, and exports, manufacturing should also support them. That trend is still continuing, that when the global demand little bit got revived, your manufacturing or export engine supported them. Where we need more clarity over here, that domestic demand is recovering overall, and if domestic demand is not fully recovered, I don't think so that central bank will get too worried about the gyrations that come from the external demand side, either taking data too high or taking too low. Right now, the focus from policymaker is purely on domestic demand, which is still in a recovery mode.
And the Indian rupee at 85.63 or thereabouts against the US dollar, is that problematic from an export point of view, and how does that balance out from a domestic purchasing power point of view?
It's not a problem yet for my exporters, because rupee has not appreciated what other EM currencies or Asian currencies have shown you. It has been moving sideways if you will look for the last 3 weeks or so. And there was a possibility, because the PBOC fixings have been getting lower, it would have gone to that particular direction. But having the mixed data point also not showing you very gung-ho above average growth or a differential to the rest of the world. Hence, rupee is operating in the zone of 85, 86. We have seen some action from central bank too, keeping rupee in that particular zone only, because they don't want to use the bullet in subsidizing exporters or supporting them when the currency is appreciating too much. So I believe rupee is in kind of a no man's land to get either too positive or too worried per se. 85, 86 is the kind of a zone where we think it can remain in the coming months also.
Rajiv, let's bring in the trade environment. And after the US-Vietnam trade deal is now in the bag, how does that make you feel about the possibility of US-India getting done before July the 9th? And how do you feel benchmark stock markets are pricing this in?
No, definitely a positive outcome. I will not say this is a second deal. I will say this is a third deal. Number one was UK. Number two was still the Geneva talks and London discussion between US and China that they brought them to 40-45%. So this is the third one in the row. But important to look is into the details overall. Definitely the number is not lower. The interim number, which we were growing around with 10%, just universal, number has got higher despite the deal for Vietnam. Now it is around 20% zone. And if it is a transship, the number will be 40%. So the things are coming to reality that tariff for the US is an industrial policy to generate a new revenue line, which means even if the deals are going to happen, the number will not be towards the zero kind of a zone. 10% is a boundary line, but way with the which Vietnam deal has happened, if a country is an US ally, or you will be in the zone of between 10 to 20. If not an ally, the number could be way higher. But JP Morgan do believe in the second half, we are moving towards a higher weighted average tariff from the US from 14% zone to almost 80-odd%. So this is largely in line with expectation. Coming back to India, yes, trade deal could happen, but the scenario over here is, will it going to be at a one bullet or will it going to be in a tranches? And it looks more likely that it's an ongoing talk, so more it will be a tranches kind of a scenario rather than the one bullet trade deal.
Right, so I've been hearing a lot about that as well, Rajiv. A final deal could be struck by Diwali in mid to late October, possibly. But the stumbling block here, and we were discussing this on the previous program in the China Connection, could be agriculture. We saw the farmers, how they rose up in Punjab and tried to march on the capital in 2024 in the run-up to the election. This is a deeply sensitive political issue amongst India's farmers. And if it means there is a perception that India is going to be flooded with cheaper US dairy and US farm products, this isn't going to get over the line, is it?
No, hence this is the reason why you can see that trade talks have not progressed at that faster pace and deal has not come through. The reason is very clear. Even if agriculture is only at close to 15% of the GDP, but close to 50 to 60% of the livelihood is still dependent in India on that particular sector space. So it's a very difficult for political scenario where you do or retouch or revisit either agriculture space or the dairy farming space overall. And importantly, it's also in the roots like where India is concerned about GMOs. India is concerned about what is being fed to cattle, which will be having an impact on the culture and the religion, what people are eating in India. So taking that into account, definitely, it should not be assumed the deal will happen at a broad countrywide level. The deal could start talking about a sectoral or a more industry cut side that maybe you start discussing more on initially engineering, auto, defense, all this kind of a sectors. And in the next tranche, you move towards more on agriculture and other side. Hence, this is the reason why I said that rather than assuming one blanket deal, a more tranches kind of a conversation will be there in place. And remember, India and US have been allies for the longer time. So taking that into account, I do believe that the US policymaker will be thinking on the line of what India's concerns are when it comes to agriculture sector or even the dairy farming sector.
Understood. Rajiv, is there a risk that the US deal with Vietnam could undermine India's status as a China +1 destination?
Difficult to say, Shri. If we take into account the kind of a positive factors which India has, like you take labor into account, the young demography into account, the cost is still cheaper. And most importantly, deals also get you access towards a big market over here. Right now, we are seeing a demographic slowdown in China, which is going to impact their domestic demand. India still have a domestic tailwind, and with the deal, you also get access to Indian markets and customers also. So taking into account the factors of production plus access to that market to sell the American good, I doubt whether that will be undermining because the size is the important criteria over here. And taking into account Indian economy size and the way which it's rising 6.5%, 7% growth rate overall, you can't move away from this particular trade bloc at this juncture. But as I've said, looking into the UK deal, China deal, now Vietnam deal, it is not one size fit all kind of a deals are coming. Each of these lenses, deals are pretty separate. So I believe next in line could be India, Japan, Korea, where there will be a customized deal with each of this country rather than one blanket one.
Rajiv, but it seems to me that the overarching focus for investors in India, whether it's foreign or domestic, really seems to be centred on the Indian consumption narrative, looking strong, getting stronger, whether it's tier 3 cities in the rural areas. How best then do you express that in stock market allocation? And are valuations becoming an issue now?
Valuation have been issue in India forever. And the most important part is investor comes to in India not for valuation or value. People come to India for growth. India and US are the two markets which have been known as a growth compounder or a sustainable earning growth market. Even when we look at the earning cycles in India recently, like how the trend has, the cyclicalities is getting reduced over here, or you can say that is also leading to lower risk premium and volatility into the markets overall. So taking that into account, like sectors which are supposed to give you higher growth will be more on the domestic demand side or which is being supported by consumption. The primary one over here will be still financials for us. Why financials? Even if growth is going to come with the lag, like we do anticipate private banks may be marginally disappoint or in line in this upcoming earnings season. But post a trough in the second quarter of this fiscal year, we are expecting an inflection point in earnings for the financial space and plus policy making support there around the corner. Financials is the right way to approach of investing into India. Remember, once the consumption picks up, it will lead to higher loan growth demand from
Yes.
MSME space, household space, mid and small cap space. So that's the prime one, and then followed by your consumer staples, consumer discretionary, real estate, hospitals. So that's where we think is the bucket you need to play the India consumption story.
Understood. And within the financials bucket, Rajiv, how are you approaching the NBFCs? Yesterday we saw a stunning debut from HDB. Are bad loans and non-performing assets, is that a concern for you? And to what degree is that going to undermine the case for financials?
No, looking at the recent financial stability report from the RBI, that has eased, I believe, a lot of concerns for the people on the GNPA side, for the scheduled commercial bank, and most importantly, for your fintech NBFCs and the NBFCs which are on the housing finance company side and the other one overall, because it clearly shows the trend that the asset quality issues are coming down. Already, if you look for a scheduled commercial banks also, the NPS levels are at a decadal or a record low over there. The concerns were more there on the NBFC side. With the recent financial stability report shows it is still not a big issue and it is coming down even on the unsecured lending side per se too. So NBFCs within our pecking order from next 6 to 12 month perspective remain the number one play because they know how to increase the loan book again overall. That's number one. And number two, they are the biggest beneficiary of reduction in cost of funds plus the net liquidity addition that's being done by RBI. And as I've said earlier, the biggest beneficiary of the rate reduction will not be your large cap corporates who have already delivered a lot. It will be your household, it will be your MSME, it will be mid and the small cap spaces who were paying the higher amount of an interest on the loan. And if you look at the recent credit growth data print also, there is a silver lining where the credit growth has started picking up again. It is the same MSME and the household space. So taking that into account, I believe NBFCs are the one which will be the leader, then followed by your private banks and then by your PSU banks.
Understood, Rajiv. So put it all together, does it look like we are in for another record high for the Nifty? At what point are we going to reach that? And where then does it put your end-year target for the benchmark?
No, very much, Sri. We are in getting into a Goldilocks scenario for India. And our base case for India is 26,500. But I'll not be surprised in this fiscal year and probably within the next 6 to 9 months, Nifty will be trading between our base case and bull case. Base case is 26,500. Bull case is 30,000. We have seen a lot of Asia and emerging markets have started getting towards our bull case side, and India has been underperformer on a year-to-date term. I'll not be surprised within next 3 to 6 months, India close that underperformance and start inching towards our bull case target of 30,000 on Nifty.
Rajiv, we'll wait and see. Thank you very much indeed for joining me on Inside India. As always, Rajiv Batra there from JP Morgan. We're back in 2 minutes. Welcome back. You're watching Inside India. Some of the stories we're keeping tabs on. The US, Japan, India and Australia have launched a new initiative to secure supply chains for critical minerals. The Quad partners met in Washington to discuss strategic cooperation, including business engagements to diversify sources of these vital resources. This move comes amid growing concern over China's dominance in minerals crucial for technology and EVs, and follows strains in trade relations with the United States. The House of Representatives is voting on a key rule to advance President Trump's big, beautiful bill after it narrowly passed the Senate. With Republicans holding a slim majority, they can only afford to lose 3 votes if approved. The House will debate for an hour before moving towards a final vote, setting the stage for potentially significant tax and spending changes. Microsoft is laying off about 9,000 workers in its second major round of job cuts this year, part of a broader push to cut costs as it pours billions into AI infrastructure. The layoffs affect teams across sales, gaming and management. Microsoft says it is streamlining operations while boosting its competitiveness in an increasingly expensive tech landscape. Coming up on the programme, we will talk about India's biggest IPO of the year, non-banking lender HDB Financial Services debuting in the markets. We'll discuss more about the sector with Macquarie Capital after the short break. Right, mixed bag for the Asian markets if we take a look at what's happening across the region. Despite the positive sentiment surrounding the US-Vietnam trade deal, what that means for India, what that means for other trade deals that are in the works as well. The Kospi and the TAIEX are performing strongly, knocking on the door of 1% gains respectively there. Set index in Thailand and Shanghai are going through some middling gains, but the laggards really are in Australia, New Zealand and the Hang Seng, which has just tested levels below 24k. Right, US has struck a deal with Vietnam, as we said, before India, and we're still keeping our eyes on negotiations with Japan. Lin joins us. There are some stumbling blocks here and mixed messages coming out of Washington. Lin.
Indeed, and we heard from Minister Akazawa, who is leading the negotiations from Japan's side, saying that he may head to Washington this weekend, but that nothing has yet been decided. We are also hearing more in the last 24 hours or so about Japan's position, and they continue to dig their heels in and hold the line here. We heard from the Prime Minister Ishiba. He met with the executives of Nippon Steel, where he hailed that US steel deal and said this was a prime example of Japanese contribution to the US economy. And then later he participated in a public debate ahead of the upper house elections. He was grilled by opposition leaders about the way that the trade talks have gone so far. But again, he emphasized Japan's national interest and the need to take a holistic approach to Japan's contribution to the US. Let's watch.
I believe we must, by all means, protect our national interests. Many countries engage in trade with the United States, but one thing I must point out is that Japan is the largest investor in the United States, and we create the most jobs there. That makes Japan different from other countries.
So it's really a difference in terms of that worldview here. You have the US president focused on the bilateral trade deficit and also on what he perceives as unfair market access in terms of certain goods like agriculture, like cars as well. And then from Japan's side, the Prime Minister really focused on the fact that Japan is consistently the top investor into the United States. He's been emphasizing the cumulative $1 trillion in terms of investment this year into the country. He says, hold on a minute, this also contributes to the US growth, US jobs as well. And this is something that we know the late Shinzo Abe used as a key strategy first time around that did actually work to good effect. This time, though, facing a lot more difficulty from Tokyo's side.
Lynn, thank you very much indeed for that. Now we are counting down to the market open over in India. This is how we are shaping up. Let's give you Gift Nifty futures as we approach the open, and 25,574.50 is what we have in terms of the futures implied opening number. If that does materialise, then we are looking at about 100 points plus to the good for the benchmark dollar-rupee exchange rate at 85.6710. On to the biggest IPO in India so far this year. HDB Financial Services made a stellar market debut yesterday, outperforming the broader markets. CNBC TV18's Hormaz Fatakia joins us now from Mumbai to tell us more. Hormaz.
Good morning, and it was a fairly decent listing, if you could call it that. Devoid of any fireworks, we listed at a 13% premium, did HDB Financial, and it remained rock steady through most part of the trading day, eventually ending with gains of around 13.5% in comparison to its issue price. Now, if you take a look at that closing, it was the third best listing for an IPO that is priced over $1 billion or more. Only Coal India and Swiggy, which had a similar IPO size, fared better on listing day in comparison to HDB Financial. And at the close, the market cap of HDB Financial came up to just over $8 billion. and on yesterday's trade, the listing day, over close to $1 billion worth of shares were transacted as well. We spoke to the management yesterday, and they told us that the focus for them remains to create long-term shareholder value. They also spoke about the fact that the rate cut cycle on which the RBI has embarked on is a positive not only for them as a company but also for their borrowers as well. They also mentioned that the IPO that they embarked on was not only to meet regulatory capital requirements but also to meet further future growth plans as well. So it is a fairly decent listing that came about for HDB Financial, and the bulls would definitely be hoping that the trend of larger IPOs not delivering shareholder returns in the long term reverses with this issue.
Hormaz, I don't want to spoil the party, but when you think about bad loan problems, when you think about NPAs notwithstanding the RBI stability tests, what are you hearing about what could go wrong and about any risks associated to the stock?
Now, one of the biggest concerns that analysts who covered the IPO have highlighted is the fact that HDFC Bank, the parent company, sold some stake as part of the IPO, and they might have to do it further, and that is because of the draft regulations that the Reserve Bank of India had put out in October of last year, which mentioned that any bank or its subsidiary cannot have business operations that are overlapping. So in case these norms are put in place and they are accepted, and in that case, HDFC Bank will have to bring its stake down further in HDB Financial from the current 74% that they own to as low as 20% or even lower in just over a couple of years. So that becomes a major overhang for HDB Financial in the anticipation of further equity supply coming in from the parent company. The second one being valuations. In terms of that, it was 3.4 times 1 year forward price to book for HDB Financial. Most of the analysts we spoke to mentioned that it is fairly priced considering the fact that its peers are a lot larger in comparison, and hence the valuation differential is very little, and that leaves very little margin for error for HDB Financial going forward. The big trigger going forward is, of course, they will be reporting their financials anytime soon, so that will be a major trigger to watch out for, along with the fact that its shareholding pattern comes out soon, and of course asset quality, the growth that it delivers in the quarter, that will be reported very soon. That will be some of the key monitorables to watch out for going forward.
Hormaz, excellent. Thank you very much indeed for that. Let's just key off some of those points that Hormaz raised in that very good report with Suresh Ganapathy, MD and Head of Financial Services Research at Macquarie Capital. Suresh, great to have you on the programme. What do you make of valuation? Would you agree that it's fairly priced or perhaps priced too aggressively?
The IPO was, of course, fairly priced at $740, and therefore the listing gain of 13% was not surprising to us. If you look at the fair value estimates that all the analysts used to have about HDB in their model, because we, of course, cover HDFC Bank, and therefore we do a sum of parts valuation, it was about anywhere between $800 to $850, and that's where the listing has happened. Now, having happened at 13% premium around $840, I think there is very little upside, and risks are more to the downside than to the upside from current levels in our view. There is stress in the vehicle finance portfolio, both from a growth as well as from an asset quality perspective in the near term, and we do believe earnings could be weaker, especially for vehicle finance NBFCs in the near term, and HDB indeed has a good 50% of the mix exposed to various vehicle segments. So that's the challenge here, and clearly it looks like there is not much money to be made from current levels based on our fair value assessment of HDB Financial Services.
Interesting. Risks to the downside. And can you elaborate, Suresh, on what you highlighted earlier, risks to the vehicle finance portfolio? How significant could they be moving forward, and what could be the overhang and the impact on HDB?
Yeah. So if you look at it, the most forecast from a volume perspective for both passenger vehicles and commercial vehicles in India is in very low single digits, around 2-3%, right? So clearly the volume growth is just not there in the segments that most NBFCs cater to in the vehicle finance space. And therefore, if you were to really look at it, HDB ended last year with a 19-20% kind of an AUM growth. There is every possibility that if the current trends persist, the AUM growth could be maybe 15, 16%, right? Which the market won't take well, considering the fact that post-listing, the stock is already trading at 2.7, 2.8 times kind of forward price to book. So there is a risk when it comes to downside projections to the growth number. There is also risk when it comes to improvement in credit costs. HDB had a pretty bad year last year in terms of the credit cost numbers. It went up from 1.3% in FY24 to 2.1% or so from a credit cost perspective. The expectation here is that number should come down over the course of this year, but the near-term trends really doesn't point towards any kind of a recovery. So they may really disappoint at overall earnings or an ROA level, which is what we need to really be careful about when it comes to looking at the stock.
Suresh, but even if those risks that you quite rightly highlighted do come to pass, related to the vehicle financing portfolio at HDB, how impactful is that going to be if, and I'm assuming here that HDB, along with the other NBFCs, has got a clean bill of health, in a manner of speaking, from the RBI's stability report? I mean, how much of a buffer do they have if those issues and bad loans and NPAs related to vehicle financing do come to pass?
Sure, look, the buffer is there. I mean, it's not that the institution is not going to become insolvent or any such thing because of a higher NPL issues. Things are perfectly fine in terms of the balance sheet and health of HDB Financial Services. But these stocks do get traded as growth proxies. If indeed growth comes down quite sharply from 19-20% levels, expectations more like 14-15%, the multiples will also correct very sharply. But remember that. Yes. So it's more a question of PE derating, which could very well happen if growth falters. And at the same time, obviously, with growth faltering, the earnings may also be at risk, right? So the bigger risk comes from resetting of multiples to lower levels, in our view, in some of these entities.
Understood. Broadly, what's the story as you see it behind non-performing assets within the context of the NBFCs, and how exposed are India's non-banking financial companies like HDB?
Yeah. Look, I think at an overall aggregate level, the health of the NBFCs in India are broadly fine. There are pockets of stress here and there, which could happen. For example, in the near term, we'll see some stress in the vehicle finance portfolio. But what is more important here is that the unsecured levels of stress is abating. Okay, with the kind of interest rate cuts that we have seen, closer to 100 basis points, the liquidity infusion that has happened from the Reserve Bank of India, and also, of course, the tax cuts which are effective April, all of that should result in a slightly better environment from an outlook standpoint in second half of financial year 2026 across the board for NBFCs. So things should start improving from second half. So we definitely don't see complete FY26 numbers being worse than FY25 in terms of asset quality. Full year numbers should see improvement in overall NPL levels. And of course, another important factor that we look at is credit cost. The expectation here is the extent of improvement or the magnitude of improvement that we see. That's where I think there could be some disappointments in the near term because of a resetting of issues or problems with respect to the vehicle finance space. But as I said, the question is magnitude of improvement rather than the actual direction in which things would move, which should be downwards in our view in FY26 or FY25.
So, Suresh, the government hasn't been idle in terms of ring-fencing the risks. We've seen stricter criteria and rules on who credit is being extended to, asset quality reviews. We talked about the RBI and the stability report, CET1, Basel III has been implemented. To what degree has that mitigated credit risks?
Sure, to a great extent. I mean, if you look at it, we did have a debacle of ILFS, post that the norms in the NBFC space have been significantly tightened and they have been brought in line, whether it is ALM issues, liquidity issues, NPL recognition issues, the compliance checks, KYC, a whole lot of aspects. The RBI has brought the norms in line with that of banks. There would always be some cases here and there where there could be a problem. At a broader aggregate systemic level, things are relatively fine. Much better. We don't see any such kind of a big risks of an NBFC going belly under. Don't think that kind of a situation we envisage. As I said, there will always be cyclical issues with respect to the space because of the segments that they cater to are also cyclical in nature, like the vehicle finance or the MFI space. But there also I see clearly on the unsecured space, the stress abating. So at an aggregate level, the system is broadly fine from a health standpoint, and we need not be worried at all clearly for the overall NBFC space.
And how would you characterize HDB's expansion strategy and their future strategy? Because as I understand it, they do want to. You described HDB as being one of many proxies within the financial space of the broader domestic economy. We've seen how the Indian consumer has been going from strength to strength. Rural economy seems to be stronger now, as do tier 2, tier 3 cities. Is that where HDB is going increasingly into consumer-led lending practices and divisions? And does that create another set of challenges for them?
No. So look, I think they do cater to segments which are a couple of notches, or customers, which are a couple of notches below that of the bank. So essentially, they do cater to the rural economy in a way, and therefore the outlook on the rural economy does become important factor. And things like, for example, good monsoons indeed will have implications, or depending upon the state of monsoons, will have implications with respect to their growth, with respect to their NPL potential, and therefore it always remain, a little bit more cyclical play, let's put it that way. But currently the inflation levels are also coming down, right? You can see the latest RBI projections with respect to food prices, and food is a very big component of rural basket when it comes to inflation, and there things are relatively cooling off a bit. The good monsoons, so far monsoons have been good in terms of its progress and development. That should also further aid recovery. So to that extent, there are counterbalancing effects which are playing through, which would help them over a medium to longer term. Though near term, as I said, there is pressure on the vehicle finance segment. So the HDB remains a reasonable good proxy on the rural play, the rural economy, and also on the interest rate cycle and the easing liquidity environment, considering they are wholesale funded. The debate is very clearly about valuations versus what is built into earnings growth and what is built into the AUM growth. That's where I think there could be a mismatch and a downside that we are arguing about in the near term.
Understood. I also understand that HDB has been and continues to be a significant lender to infrastructure projects. How do you see that?
Not at all.
That part of the business? No?
Yeah, so HDB is largely an exposure to retail, nothing got to do with any corporate or infrastructure exposure.
I see. And where then do you think the strength comes from? I mean, HDFC is the parent bank, very well regulated. We heard from Holmars earlier talking about how HDFC has been selling its stake in HDB. There are overlapping business concerns. Are they going to have to take that stake down further because of regulatory pressures? And is that going to cause an overhang on the stock?
Yeah. So look, there are two kinds of overhang here, right? One is the SEBI minimum public shareholding norm of 25%. Fortunately, the IPO came at such an attractive price that the minimum public shareholding norm immediately got met on day one itself, right? So it's more than 25% public shareholding. So things are fine on that front. So there's no overhang coming out of it. See, HDFC Bank has always maintained that for them, HDB to some extent is a financial investment, not necessarily something that they believe is going to be a very strategic long-term holding, so clearly there could always be a selling, but there's no compulsion for them to sell, at least in the near term. The compulsion can come only if the RBI regulations come through with respect to the overlapping business. And fortunately and unfortunately, the way we look at it is that there is not much clarity on that. So there is no immediate term pressure for them to sell the stake and get down to 20%. There is enough time frame and timeline for them to look at it. So no near-term overhang which will come out of the selling.
Right. So ultimately, Suresh, just to wrap things up, where does your recommendation stand? Is this a buy, or to what extent should we be cautious here, given your point, and very well taken it was, about the valuation mismatch?
So look, we don't cover the stock. So we are not, as per compliance, we're not supposed to give any kind of a rating on this. But of course, we do value the entity in our sum of parts valuation in HDFC Bank. That range is about 800 to 850. So you can imply where exactly our view is on the stock.
Suresh, we'll wrap it up there, sir. Thank you very much indeed for joining me on Inside India. Suresh Ganapathy there from Macquarie Capital. In the meantime, chip giant Honhai is reportedly pulling back hundreds of its Chinese staff from its iPhone factories in India. The move could potentially hurt Apple's manufacturing strategy in the South Asian country. Many engineers and technicians were asked to fly back around 2 months ago, according to a Bloomberg report. Staff from Taiwan, however, are staying back in India. Indian Prime Minister Narendra Modi is embarking on a five-nation visit. That's his longest diplomatic tour in the last 10 years. Modi stopped in Ghana first, pledging deeper security and health ties with the country.
Vaccine production. We discussed cooperation in vaccine production. In the area of defense and security, we will move forward following the mantra security through solidarity. We will increase our cooperation in areas such as the training of armed forces, maritime security, defense supplies and cyber security.
Over the next 8 days, Prime Minister Modi will visit Trinidad and Tobago, Argentina, Namibia and Brazil, where he will be attending the BRICS summit, and we will continue to follow the latest developments out of that summit and his tour. Indian markets have joined the trading day. We will look at some of the movers in Mumbai after this short break. Indian markets are just joining the trading day. The Nifty 50 in the money, up by about just a fractional 0.1%, but holding it around 25,500, just under that level. The dollar-rupee exchange rate at 85.6925. Checking on Indian government bond yields while we look at the broader markets. The benchmark 10-year yielding 6.29%. At the shorter end, 2-year bond yielding 5.719. Let's take a look at some of the movers in the Indian markets today. We are watching shares of Nika, and this is after reports suggesting that Hong Kong-based investor Harindapal Singh Banga and family are about to offload shares worth about $150 million in the Indian beauty and fashion e-commerce company via a block deal. As of March 2025, the Banga family held a near 5% stake in Nika. Taking a look at the telecom stocks space, debt woes continue for Vodafone Idea, but the government is not looking at increasing further equity to bail out the telco. Here's what Indian Telecom Minister Jegarajah told CNBC TV18 in an exclusive interview on the issue.
We can't increase it beyond 49% because the minute you do that, then it becomes a PSU, which is not our intent.
But are there other options being considered?
At this point of time, the equity option, increasing the equity option is not an option.
India's Telecom Minister Jegarajah Scindia there. Now, before we go, let's talk about India and the Olympics. India has officially entered the race to host the 2036 Olympic and Paralympic Games. A delegation from the country pitched for the city of Ahmedabad in Gujarat to organise the event. Several other countries, including Saudi Arabia, Indonesia, Turkey and Chile, are competing to host the 2036 Summer Games. The last time India held a global multi-sport event was in 2010 when the Commonwealth Games were organised in New Delhi. But it became a playing ground for multiple scams, even in the government. That's all the time that we have today on Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.